2022 onwards. He is tracking Indian markets, and he is basically a value investor who looks for small and mid cap focused investing, and he understands the business cycles and accordingly prepares strategies to invest in cyclicals and commodity stocks. So over 3 decades of experience of Jiten sir, and likewise for Nitin sir, he had previously worked in various roles and very rich experience. He had worked with Crisel and he was in L&T previously, and he also focuses on identifying value in public markets with long-term orientation, and also small and mid-cap stocks with sound fundamentals. And he understand basically look out for multi-baggers and the commodity and cyclical stocks. So welcome sir, welcome. And recently team Aurum completed 4 years, and Aurum Capital is a SEBI registered investment advisory, and since its inception it has given a CAGR of 25.7%, which is approximately 150 in terms of absolute returns. So with this, I welcome my guest, and sir, over to you. Any opening remarks or?
Yeah, so it's great to be on Spaces, and it's always nice to basically share our experiences, and we are looking forward to these Spaces. So we can start right away.
Yeah.
Hey, great. Thank you, Prince, for organizing this, and thank you everyone to join. It's always pleasure to talk to the fellow investors and share whatever we have learned from the market and also learn from the experiences of fellow investors. Thank you for organizing this.
Right, sir. So, sir, we'll be like we already have some questions I have jotted down, so I'll be asking those questions, and then we take speaker requests from audiences, and likewise we will take the questions. So, sir, to begin with, like you people are known for cyclical. So, my question would be like how one should go about cyclicals. Like, cyclicals means everybody cannot understand, but if a layman or say a new investor has to go for cyclicals, how the approach should be?
Yeah, so I mean, in various forums, I have talked a lot about cyclicals. See, cyclicals is nothing but value investing. To be honest, uh, the thing is that there are deep cyclicals like the commodity companies and all that, and there are the other companies are something like a FMCG is less cyclical. Now we have to understand that cyclical doesn't mean only business cycle. There are primarily three cycles which investors should be aware of. One is the business cycle, one is market cycle, and the third is economic cycle. And almost all stocks are affected by one or more of these cycles. So understanding of cycles, I think, is very important. Even if you don't want to invest in the deep cyclicals or the commodity cyclicals, but even supposedly non cyclical companies do have market cycles and are affected by economic cycles. So understanding of cycles is very important, is what I think. Uh, and accordingly, the thing is that the kind of returns and drawdowns in the deep cyclicals will be very high. So when the cycle is good, they will give much higher returns, whereas when the cycle is in downturn they will fall a lot more against the less cyclical companies. But then the less cyclical companies will also are very much affected by market cycles primarily. So one has to understand that, and see, eventually it all boils down to understanding the sectors, looking at the valuations, and always we always try to uh, basically play with a risk reward in mind, in the sense that what is my downside and how much upside I can do in a particular stock or in a sector. So that's how we go about it. I mean, there are there's a lot of understanding that is required, because you not only have to understand the business, you also have to understand the cycles of the business, as well as keep a track of the market cycles.
Right, sir. So, Nitin, sir, I have seen you on various forums. You always focus on behavioral aspect of investing. So, how we can condition it to our advantage?
Yeah, absolutely. So, see, investing is more than 90%, I would say, is behavioral, and less than 10% is, understanding the financials. Behavior is extremely important in the market, both from, you know, understanding the individual companies, our protecting our interest in individual companies, as well as our reactions uh, to what happens in the market. And if we are able to control our nerves, then we avoid a lot of mistakes. And if we are able to avoid a lot of those common mistakes, we make significant amount of money in the market. For example, let's take the extreme cases, because that's where we commit a lot of mistakes. Let's take the example of March 2020, when COVID struck us, and the markets were going down. And in hindsight, it's very easy to say that it was bottom. We should have bought this. Even if you are not bought, but you should not be selling at least at that panic level, because if you sell at that panic level, your portfolio will remain just 25%. Because that has gone at least 4x. In multiple cases I've seen 4x. And if you end up selling at that level, you'll not be able to make money. So at least control yourself when others are, or market is behaving in certain ways. Many a times, doing opposite of market, what market is doing, may help you. And this is not only true in terms of larger market, but it is also applicable to individual stock. So we may react to many a times to adverse news. We may end up reacting to price movements, which may be true from the trader's perspective, or technical chartist perspective. But if I am an investor looking at it from the long term perspective, if I had done my work on the company, and if I had no other reasons other than price movement, I should have a second thought about going away from that investment. So I should write down my investment thesis, understand that, and then understand the risk, and make a long term commitment in those companies. So that's very important, and behavior control comes into play multiple times in each and every investment that you make, in each and every stock that you make. There is no such investment that you will be making where it will go up only in one direction. Very rarely it will happen. Almost in all the cases, I've seen that stock goes down, and it goes down multiple times before it gives you, long term, uh, uh, sustainable, handsome return.
Right, sir. So, Jiten, sir, a follow up on the same question. So, basically, investing individual money is one thing and managing public money is one thing. So how we can, I mean, how difficult do you find it to handle the clients in such situations when the market is undergoing such volatility, or maybe period where price correction is happening? So how tough it is for you guys?
So, luckily, we have a very good set of clients who do understand these behavioral aspects. I mean, we have been writing to them. We have something called as investor forum on our website, through which they can communicate with us, where we will answer their questions on behavioral aspects, as well as on the companies under our research, if they have any questions on that. So. During all these periods, we keep on guiding them on the behavioral aspects. The good one good thing which we have seen change in our own investing style is after starting Aurum Capital is that, we are now far more selective because, see, you will always be judged. So, the kind of companies you want in your research coverage have to be thoroughly, looked into. We look at a lot of aspects before, recommending any stock, and that has percolated to our personal portfolios also. So there are, a lot of, we say no to a lot of things, and that is very important. Saying no, because in let's say in current time also, you will find a lot of ideas coming your way. Ideas don't come your way when markets are down. Uh, so these are the times when ideas come your way, and it's very easy to basically get carried away. So the whole art of saying no is very important. So we've always believed that error of omission is fine, but error of commission is very harmful. So that's the process we have developed, and it has helped us in our own personal investments also. So managing clients basically aspirations, and providing them with good research does require a different mindset than managing your own portfolio.
Right, sir. So, sir, we have one question from Ameya. He is asking, what is the best way to play the manufacturing sector? Do you think India is really prepared on qualitative aspect to take a bite of Europe? Will companies really move out if there is possibility of things settling down in Europe?
So again, see, we kind of have liked this sector for a while now, and uh, we are happy to say that we were one of the first to get into the capital goods and manufacturing bandwagon uh, last year itself, and this sector has done well. And after almost a decade of slowdown, this sector has now kind of turned around. It is quite evident now. If you see the results, if you see the commentary from the companies. So, specific to Europe, we don't know how long this war will last and all, but we think that we really think that a lot of manufacturing will move to India. So this sector, I think, can be a good long-term trend we see. Just like we kind of like chemicals also from a long-term perspective. But then again, one has to look at valuations, whether you are comfortable with valuations or not. But yes, manufacturing capital goods looks good for some time. Having said all this, we might even exit some capital good stocks if we find this reward is not in favor. So just a caveat, because we are already sitting on very good returns in some of the stocks.
Right, sir. So, Anirudh, you can unmute and ask your question, please.
Sir, hello, sir. Uh,
Yeah, we can hear you. Ask your question.
Sir, I don't have any question, but when sir is speaking, the voice is breaking, sir. Kindly please do the needful so that we can hear it peaceful, sir.
No, I could hear him properly. I didn't face
Yeah,
any.
sir. Even I can hear, and even the comments some of our listeners have identified. Anirudh, you can try one thing. You can drop and try with laptop if the issue persists. So, Nitin, sir, we have one question on new education policy. So, one person is asking if the new education policy gets implemented, then more or less science subject would remain same. Other subjects might change. How much is this going to affect publishing companies? Second, if you are able to quantify in terms of revenue.
So it is uh, uh, very premature to say that only science will change or only history will change. Unless until we have the NCF. So new education policy, as you all know, NEP 2020 has already come in 2020. It's 2 years now. The follow on to NEP is NCF, that is the National Curriculum Framework, which works under the umbrella of new education policy. and this is the fifth time NCF or curriculum is getting changed, and it is getting changed after 2005. So it's a pretty long time, almost 17 years. We know that how the world is changing almost every 2 3 years. Our laptops get changed, and now we are changing our curriculum after such a long time. So it was definitely on the cards. It was supposed to happen a little early, but uh, better late than never. So now it is happening, and what I could understand from the discussions or various papers which are getting published, I understand that this is going to be on a regular basis. So every 3 4 years, curriculum will get changed. It will not be such a long duration after which the next curriculum change will happen. So every 4 years, 5 years, curriculum will get changed. One. Second is the advantage for publishing companies is all these second-hand books. So second-hand books, we may not understand if we are in big cities studying in good English medium schools. But if you go to tier two, tier three towns, you will realize that there is a very large second-hand books market, which gets overnight discontinued because your books are no more uh, in line with the curriculum changes. So new books will come, and then it is a growth of at least 3 4 years for all the publishing companies. There are some more angles to it. It's not going to be very straightforward. There are a lot of things. One is when the curriculum is getting changed, it is not changed from first standard to 12 standard just in 1 year. It is a gradual process. It will happen to first standard, third, fifth, seventh, and then next year it will be second, fourth, sixth. So odd and out, odd and even classes will get changed in 2 years. Third is this year we are having, and since we are tracking paper sector very closely, again we entered little early in that sector. We were lucky actually. We made good money, and when we were tracking paper sector, we realized that, and people were saying that it's putting a lot of pressure. It might be putting a lot of pressure on paper on publishing companies, which is true actually. But if you look at it from their side, we realize that it is actually killing a lot of small publishers because paper historically paper companies were selling in July August almost at credit to all the publishing companies. Papers were available. Paper companies were struggling to sell in July August, but this is the first time, at least in known history, when paper is not available in the month of August also. So publishing companies are struggling big time, especially the one which are not having uh, strong balance sheets to get the paper from the market. And if they are not getting paper on credit, they are not able to publish the books and sell it to the bookstores and then recovering money over a period of time. So that cycle is broken now. So all the publishing companies which are having good balance sheets, uh, which are having corporate structures, they are getting again benefited from this change that has happened. So this is a major disruption again for publishing companies, and good publishing companies are getting benefited. So if NCF gets delayed for whatever reasons, this is going to remain over there because paper is not available. So both these things put together will have a pretty good or decent cycle for publishing companies.
Right, sir. So, Jiten sir, one question is like, how do you gauge the industry is going through depressed earning as during COVID, hotel airlines had an earning compression. But if you talk about today, which sector is having same and how do you track demand and supply?
So again, a lot of sectors have actually kind of moved up since COVID. Uh, so again, it was quite easy during that period to look at. We kind of looked at. We could get into hotels. We could get into paper. We wanted to get into the the multiplex, but somehow we were waiting for lower levels. We couldn't get there, but the thought process was to get into those. Uh, so it was quite simple then. So I'm saying, these kind of opportunities come rarely, and if you can pick it up, if you have, and that's where all these behavioral, aspects come in. Uh, you know that you have faith. I was always of the view that humanity will obviously overcome COVID, and the need for hotels is going to be there. And you also have to see, that all the stronger guys, the survivors, will make merry, and that is exactly what is happening with, let's say, example, hotels or even with airlines or something. Uh, so that was the thought process that time. Now, we are kind of we were not invested in financials, though it is huge part of the indices, upwards of 35%. We had 0% in financials and banking, just because we were quite sure that this is a sector which will struggle. And we kind of waited. A lot of our clients did ask us, why we don't have anything there. So we waited, and now we have, entered the sector, and we are ramping it up and so on. So financials and banking is something which we think that, can do well. Valuations are favorable. Cement is one which we have been saying for some time now, which we think where valuations are favorable. So just this couple of sectors we kind of like, and where one can look at.
Right, sir. So one question is, sir, Nitin sir, a view is requested on steel sector, where it is heading. Which all players will be affecting the most in cycle bottoming out?
Uh, so in steel, actually, we have made again, an entry. We completely exited from steel couple of months ago, and in fact, actually, I tweeted about that time. Uh, but the valuations were really mouth-watering in some of the companies, and margin of safety was significant. So we made an entry again in the steel sector, and we believe that worst is over. There are a lot of things which come during the worst time, and duty was the final nail in the coffin kind of move that has happened. I think that should get reversed. It is expected to get reversed, but we are not counting only on that. I think the demand is still there. The prices of the end products of steel companies have run so much so that the end customers were getting affected. Now there is a correction in their prices. Demand is still visible. When we are attending the con calls or talking to the management of various consumers of this steel products, they are pretty happy about it, and there is definitely a very strong demand from their side, which is continuing because their sustainability was in question if the steel, remained at those steel prices remained at those elevated level. So demand is there. Everything is so if demand remains over there and prices are in check, definitely steel companies will make money, and their valuations have come down in many of the cases. More than 50% correction is there in those companies. It makes complete sense to make an entry in those companies.
So I would like to add one more thing here. Basically, you must also see the balance sheet of many steel companies. Uh, Fantastic, deleveraging has happened. They are far strong from a balance sheet perspective. And another good thing which has happened is not a lot of supply has been added. One of the, let's say, a PSU steel company, you see that they have been reducing that, and there are no announcement of any big capacity to be added, and so on. So these two things also are important. So balance sheet strength is visible, deleveraging has happened, and no significant capacity is coming in.
Yeah, very right. Good point, Jitin. One more thing is that don't expect, multi-bagger kind of returns from steel companies, which was there from 2017 because their balance sheets were leveraged that time, and there was when operating, cycle kicked in, you had the leverage cycle helped you in making those stocks really rocket. So it is not going to happen that way this time. It will give you return, handsome return, but not 10 bagger or 20 bagger. Don't expect that. Go with minimum expectations, and when returns are coming in, built on that, see where the valuations are heading, how is the demand, and then keep a close eye, close watch on those kind of things, and then take the decision to exit subsequently. But I think we are in a place where the risk reward is in favor for making an investment in a steel company.
So again, Prince, I will come with an example here. I think uh, one of the companies which me and Nitin invested in, uh, uh, I think we are talking about 2016 or 15, around that point in time, steel company. Uh, so that company was available at a market cap of 200 crores, around that, maybe 200, 250, whatever, with a debt of 2,400 crore. Now, see how, when a cycle plays out, what can happen. This company currently is at a market cap of 4,100 crore. All the debt is gone, and it is actually a net cash company right now. So these things can happen if you get it right. But at the same time, the risk was that, that if the cycle didn't turn around, this company would have closed. So those kind of risks are also there. But I just wanted to bring an example where, where cyclicals, if they are played properly, the kind of wealth they can make. And we are lucky to, basically participate in this story. Uh, and of course, it was Nitin who kind of, first goaded me into it. And this is a company which I had invested in the past cycle also. And I was a bit skeptical, but then we put our heads together, and both of us, this is obviously before we even launched Aurum and all that. But just an example, how beautifully a cycle can play.
और होता क्या है जीतू भाई, जब वो 55 रुपए पे था ना, तब कोई खरीदने नहीं आएगा, और जब वो 2000 रुपए पे है तो कितना वॉल्यूम हुआ है. We have seen the kind of volume when it was at 1800. It was in circuit actually that time. And we have been talking about the same thing, buying the pessimism. तो जब 55 रुपए पे है तो सब पीछे भाग जाते हैं, और जब 1800 रुपए है तो सब हीरो बनने आते हैं उधर. it's that way. The market is really, works just opposite the way we would like it to behave.
And that is the reason for this is, people look at PE, which is probably the worst parameter to look at. 55 रुपए में PE तो था ही नहीं, because the company was probably loss making. 60 rupees में whatever, the company was loss making. And at, let's say, 1800 or 1500, the PE was just 3 or 4, whatever. So people think this is very low PE. People don't understand that this is just not the right way to look at the deep cyclicals.
And it doesn't mean that 1500 pe company kharab hai. The company is doing well, but it is not making any subsequent sense for me to hold.
Exactly.
Sir, so you can ask your question from the speakers. Sanju, you can unmute and ask your question, please.
Yeah. Thank you, Prince. My question is related to the defense sector. Why is Hindustan Aeronautics Flying and Cochin Shipyard not selling? Is it because of ROE? And I heard Sanjay sir is also in this Spaces event. I also heard him, a couple of days back on CNBC. So why is that? Why is that? Are those companies not good? Cochin Shipyard or Mazagon Dock?
Sorry, we will not be able to take any stock specific questions.
So can you give your views on the defense sector, please, now?
Yeah. We are. I mean, we have recommended the defense sector. One of the companies there. We like that sector. Though I think a lot of run up has happened, so one should be careful in entering now. But yes, I mean, the thing is, defense sector. Uh, uh, there changes were going to happen. That was evident, I think, in 2015. But then the gestation period for getting all the things in place took many years. And that is what people have to understand, that, whenever their government is involved, it will take time. But now it is taking off. You are seeing they are having huge orders. A lot of the Atmanirbhar theme in defense is playing out, and I think this sector will do very well in the future. Of course, one needs to basically uh, look at valuations and then make entry. But yes, we are very positive on the sector.
Yeah, thank you, thanks.
Thank you, Sanju. So, Nitin sir, one person has asked where about the sugar sector. Where is the cycle right now? Has ethanol story actually taken out the cyclicality?
I think it will be better if Jiten answers this because he gets it very closely than me.
Yeah,
Yes.
so ethanol story is there. Sugar. So again, I think I have tweeted many times. Basically that a narrative was being built that sugar sector is not cyclical. I don't think that is true. Yes, cyclicality has reduced a lot, and primarily due to ethanol. I do agree to that, but then. For a lot of companies, for some companies 60%, for a lot of companies 70-80% of their revenues and still come from sugar. So one has to track sugar production and so on. There is only a certain amount which can go towards ethanol. I mean, the whole sugar production, sugarcane production cannot go towards ethanol. We have to understand that. So sugar dynamics also one should look at, and also one has to understand that there is a political risk involved here, in the sense that government has supported this sector during the tough time by making a lot of policies. I've always believed that whenever government will support when the time is tough, government will take something when the times are good. So then they will put uh, some duties or some mechanisms by which it will not, basically it will not let them make huge profits is what I think. And cyclicality will be there at current point in time. I mean, we are already out of the sector. We had entered last year, and uh, very quickly it played out. Actually, to be honest, we didn't expect the stocks we invested in doubled in just 2-3 months, and from that point in time, the risk reward was not in favor. So we had exited. Since then, we have stayed out. Uh, it could be because we found some other sectors where the risk reward was more favorable, and so on. So it could be our exits could be because of this also, that we might think that this sector might still do well, but then there could be some other sector where our risk reward is in favor, so we will exit. For example, let's say we expect that these sugar companies can give let's say another 30% in the next 2 years, but if we find a sector where we are comfortable and we are reasonably sure that this sector can give us 60% returns in 2 years, for us it would make sense to switch. Of course, we will also look at downside, what are the downsides. So basically, risk reward ratio we will evaluate and act accordingly. So that's exactly what played out in sugar for us. We exited because we found some other sectors where risk reward was in favor, and this kind of worked because the stocks are at the same level where we exited. Uh, so, as far as sugar is concerned, I would say yes, cyclicality is there, reduced cyclicality is there, but some amount of cyclicality is there. Currently, we are neutral.
Right, sir. So, Nitin sir, which two, three spaces you see value is available and you guys are looking deeply, and what are one, two spaces which you think are overvalued at current point in time and should be avoided or maybe watched carefully?
There are sectors like cement, what Jiten mentioned a while ago. Infra is another sector which is not, which has not given good return so far. It has remained almost flat. So that's another sector which is going through some sort of pessimism. Then the emerging opportunity, of course, in education sector that we talked about, publishing sector. We have recommended one stock from there as well, and that's an opportunity that is there. If it works out, then it could be an opportunity for a couple of years. Uh, then financial services, another sector which we feel should do well, and we have moved into that as well. Very recently, we have recommended a couple of stocks from there. Real estate is one which has done so far well, but we feel that there is some more meat remaining over there. So we are invested in that. Hotel and tourism based stocks have done well in last more than 1 year now. It's almost 1 year, 5 months, 1 year 4 months. It has done well, but we think that it has not reached to the peak valuations, peak optimism in that sector so far. The peak results, peak optimism, peak valuations still some time away. So we are holding that sector. We may decide based on individual stocks whether to retain or exit from all these sectors where I'm saying that we are still positive or the peak has not come. If we feel that in any one of these stocks from any of the sectors where the valuations are not comfortable, or if any better opportunities available in other sectors, we may make some switch. So those kind of technical calls we may continue to take, but overall we may still be positive on that sector.
Any addition from Jiten sir? Yes, sir.
Hello.
Yeah, yeah,
So,
yeah. Now you're audible.
yeah, I think what the person also wanted to know was sectors to avoid. Uh, Nitin, you want to go or you want me to go? What?
No, no, go ahead, go ahead.
Okay. So I think so. We have been quite vocal about basically all these new age companies which were listing and coming to the market with IPOs. So we still think that though they are some of them will be great businesses and will be really big. At this point in time, we will wait because the mortality is quite high in these kind of businesses. One needs to, we don't mind buying a bit higher than what they are now, but we need to see some path to profitability and all. So that is one sector which we are staying away from, but of course we understand that sector. uh, in my personal capacity, I mean, I am invested into uh, you know uh, in a private equity firm, and we do investments in early stage. So our investments are early stage, but we believe that IPO is probably when basically everything is taken out from the it's more of an exit for the early investors, and one needs to be careful, especially when valuations are so high. And so some company which is, let's say, the last round happened at, let's say, a valuation of, let's say, 2 billion, and if it comes at a 10 billion valuation in just 1 year, that uh, you could be in for a rough ride and so on. So that is one which we have avoided. Other one which we kind of stayed away for some time is IT, but we are looking at it, and if we were expecting a correction, I think correction has come. Uh, Still, we are not very comfortable with valuations for most of the companies, but we are on the hunt for something which is available at a good valuation, and so.
All right, sir. So, Nitin, sir, you talked about infra. We have one question on infra. That person is asking, infra is capital intensive and so is mostly debt ridden. So, should one go for a basket buy or should be a stock specific? How do you pick infra stocks considering their high debt driven balance sheet?
Yeah, yeah. So one needs to be mindful of couple of things when one is making investment in any of the companies. Forget only infra, but any of the companies. This include the strength of the balance sheet, wherein you see that they are able to service the debt. But if you are taking a risk, say for example in 2016, what Jitin was talking about of that steel company where it could be touch and go. It was like we were getting a sort of signals that cycle is turning around. If turns around, then we'll make a lot of money. But that may not be the case with other industries. So each industry may behave differently. Infra or other companies where we have to make investment, we have to be little careful about the balance sheet strength. We should see that there is not equity dilution on a consistent basis. If that is happening, then it's a problem. If cash flows are not in line with the profits, then again it's a poor profit that you are earning over there, because ultimately you will have to pay if the cash flows are not in line with that. So you have to see the operating cash flow. I have made a lot of case studies on that, presentations on it. It's there on YouTube as well, wherein I talked extensively, especially about operating cash flow. So look at all these parameters and then make a call. Basket approach may not be really good idea for this, because the very stock specific investment approach may work wherein the valuations are at a distress level, industry wide. One second is you are not too sure which company is going to perform, or everything can perform, so you take a basket approach over there. Again, there also you have to see that companies are going to survive. If there is high debt over there, then you may like to reduce some exposure over there, or limit your exposure on those companies. So these are some of the hygiene factors that you keep in mind. Infra, there can be debt, but you look at it from the balance sheet strength perspective. These are capital intensive businesses, no doubt about it. But it doesn't mean that capital intensive businesses don't make money. I made good investment in one of the infra companies when it was going through this entire sector was going through a lot of pessimism after 2008-9 debacle. So you identify the company based on the this strength, and then you be invested in those companies from long term perspective. One more important point is the quality of the management, because corporate governance can be very significant, very important in these companies. So don't compromise on that. Look at the the promoters' stake in the company. Look at their pledged shares in the company. If it is below 51% unpledged share, then be little careful in those companies.
Yeah, I mean the thing is the I'll add one more point here. Basically, Nitin already talked about it, but then I would say that if you have to invest in infra company, stay with quality and stay with companies who have been there for a long time, have waded through past cycles also, and come out terms. So that is very very important because it is not an easy sector. So if you go down the quality curve, then there could be serious damage to that particular investment. So stay with good companies. I mean, hardly investable companies in that sector you can count on your fingers is what I would say.
Right, sir. So, Dilip, you can unmute and ask your question.
Hello, am
Yeah.
I audible? Yeah. Uh, First of all, I would like to thank Prince sir for arranging so beautiful session, and thanking Jiten sir and Nitin sir also. My question is goes like this. Just a second. I just missed it. Am I audible?
Yeah, you can ask.
Yeah, yeah, absolutely.
Sir, yeah. Jiten sir and Nitin sir, I would like to first know what framework actually do you use to zero down on the stocks in your portfolio, so that we can sit on the cycles for long, wait for it, and get the full benefit of it. First of the thing is to choose the stocks. So how do you actually choose the stock? Is my question.
Jitin, you want to take?
Yeah. So again, the thing is, me and Nitin, we cover a lot of sectors. So we are kind of, having a lot of experience over the years in number of sectors. I mean, we do track huge number of sectors, to be honest. Now the thing is, we are always on the lookout, where things are not good. So and see if if it is a down cycle or if there is a disruption. So you have to distinguish first whether it is a down cycle or if there is a permanent disruption. Uh, and that you will obviously be able to understand if you understand the sector and what is happening with the sector. Uh, I'll give some example. How do you basically ideate and how do you, look at sectors? So I can give some example from last year, maybe one example from now, and so you'll get a sense of what we are talking about. So as I've talked before, last year, for example, during the second wave, hotels stocks got butchered, and they were basically being priced to extinction almost, and valuations were very good. I mean, the whole hotel sector was available. I think, at a replacement cost of 25% or so. Typically, I think that is very, very mouth-watering levels for any sector. Because what happens is that when these kind of things happen, supply will definitely go out of the system. So all the unorganized people will go out. So we were kind of expecting that 20% of the capacity will go out of the system at least for some time, and actually that happened. Now the revenge travel and all that is something which has taken everybody with surprise and has taken us also with surprise, to be honest. We were expecting a gradual kind of return to normalcy and so on, but this happened much faster than we thought that can happen. But the idea was to buy at distressed valuations. Another thing, paper stocks, the uh, whatever wrong was to happen was kind of happening with the this thing. Pulp prices were high. Input costs were increasing, and demand was not there. So companies were making losses. Even the good companies were making losses, and the valuations were very cheap. And I actually tweeted a thread about a week back or something on how uh, what is the way we thought about this, and so one company was available at a market cap of 1100 crores, enterprise value of 1600 crores. This company, based on the capacity and reasonable understanding of the paper cycle uh, and past history and all that, you could guess that this company can do 800 crores of EBITDA in a decent time, not at the best time, in a decent time. Uh, in the best time, I think it will do more than 1,000 crores EBITDA per year, which can happen this year. So this company was available at a market cap of only 1100 crores. Uh, so when this kind of opportunities throw up, that is where basically understanding of the business comes in. We talked about financials also. Now we think financials, worst of NPA is behind. Now you're seeing credit growth and so on. So basically we keep it simple. Uh, the key is that you must understand the sectors which you're looking at, and there are certain sectors we kind of stay away from. For example, tea. Number of times things happen in that sector. Tea prices go up and all that. But we, over the years, I mean, I've been studying cycles for a very long time. I've seen that you never make a lot of money in tea, even if the cycle is good. So we kind of pick and choose, and we kind of we have a bias towards not investing in that sector just because of the history and so on. And at certain times we do miss some, which is fine as long as the what we have is doing well.
Yeah, yeah. Even I would like to add, in addition to tea, we would have never invested in hotel. But we invested primarily because the valuations were so attractive at the time of second wave. It was like a no-brainer kind of a deal. So we went ahead and bought some of the good companies from that sector. So basically, whenever you are selecting, it has to be in such a way that risk reward is in your favor, and you have to be little early in the game when you are going for that sector. You may have to display some sort of patience because sector may be undergoing through a lot of pessimism, and you will have to wait before it comes back in the mainstream. But that's what behavior is all about, and that gives a lot of comfort in terms of margin of safety. And then once it comes back, it rewards you handsomely.
And so I will like to add. And also, there was a in the question, it was that, to ride the full cycle. I'm saying that you need not always ride the full cycle. We should never have the obsession to, basically exit at the top. As long as we have made sufficient money and we keep on evaluating the risk reward at different times, and we do a lot of these tactical things, though we feel that there could be some more upside, we will still, get out of that position, leave something on the table because something else could be attractive and so on. So the idea is, there are multiple ways. You will want to ride it to the max, but that is the holy grail. I don't think anybody can do it. So you can have some strategies, that, okay, this is the kind of return I will be happy with. Uh, and then if that comes and if it still looks very good, I'll tell you one thing. When all these companies still was doing very well, it looked very good. I mean, nobody would want to exit at those point in times. But you see that, when companies start making, 30,000 rupees per ton of margins, that something will give. That's just from experience. It looks too good to be true. A company like Tata Steel having quarterly profit more than TCS, and so on. So that this will give. So you basically exit at this point in time based on the experience, and that the. You have to understand that when prices become unremunerative. Another example which happened a few years back was, the graphite electrodes. Prices went up so fast, then the cycle collapses, because obviously there is either demand destruction or there will supply will come. So one of these two things happen, and that basically that's the whole cycle. So you should be aware of that. I mean, we've always been proponent of selling when things look the best.
Right, sir. And you recently tweeted about the same. We should not be like looking for bottoms and tops. The idea is to make a good amount of money. So with this, Nitin and Jiten, sir, I would request you guys to tell how the idea of Aurum Capital was deduced and how you end up starting this venture, and how our audiences or attendees can benefit from your venture. So yeah.
Nitin, you want to go?
Yeah, go ahead, Jitin bhai.
No, no, you go ahead.
Okay, so Jiten and I met in 2015. Many people do not believe that we met just 7 years ago, and and it so happened that when you do good and with all good intentions, I used to conduct monthly investor education sessions in Pune, and somebody told me about Jitin that time that he understands cyclicals quite well. Why we don't invite him? So I spoke to him, and he came and presented the presentation that you would have seen in many forums later on, CFA forum and many other forums he presented. So that was the first presentation he made in our group. It was really an eye opener for me because I was not very comfortable with cyclical either, and it helped. And later on, we understood each other quite well. We understood that our mindset is almost similar, though he was majorly into cyclical and I was into value investing. And as he initially said that cyclical is nothing but value investing, and he was so right about it. So our thought process was almost similar, and since a lot of regulations were there, we were not talking about stocks. and a lot of friends and people in circle were talking us to start something. And I asked him one day that should we start something, and he agreed. So we started this with that objective of sharing whatever we have learned uh, in the form of some service. So Aurum Capital was formed, and again, initially we didn't do quite well actually. In first year, our returns were not as per what we would have expected. In fact, our first stock didn't work out. There was a corporate governance issue which we found out. We discovered actually in that company that corporate governance issue. And what Jitin was saying that our investment style actually became more matured when we started recommending stocks to our client, because it was very very important for us to be very careful while we are recommending any stocks. So it helped us to become more mature in terms of the recommendation. And today we have two services in Aurum Capital. One is the value investing, which was launched on our platform 4 years ago, and the second one is cyclical bets, small case. It is on small case platform. And so far on value investing, we have given 38 recommendations. And we believe that out of 10, 3 can go wrong. But touchwood, so far out of 38, two have gone wrong. One was the first one, which the first stock that we recommended, and where we found corporate governance issue, and we exited immediately because that was something we didn't want to compromise. Had we kept it, had we not and exited, it would have been still multi-bagger. So our investment thesis was right. Though we didn't want to compromise on the second part, which was more important for us, we exited. So two stocks have gone wrong out of 38. A lot of things we implemented from value investing perspective. And a small case, total 29 stocks were recommended in 18 months. And out of that, again, only one stock we have exited in negative uh, uh, in that small case. So total 67 stock. Out of that, three is where we have booked losses, and the remaining all have worked quite well for us, and that's where the returns are. We don't want to compromise on corporate governance. As I said, we look at balance sheet, we look at pessimism in the sectors, and then we go and invest. We look at the cash flows of the companies before we make our investments, and we look at a lot of pessimism. So wherever we find pessimism and little bit of hope of or little bit of signs of recovery in that sector, we go ahead and take the chance in that sector. While doing so, we also ensure that, or we also look at that the companies are not going to die while we are investing in those sectors. So this is in brief about how it happened. Jitin, you want to add?
Yeah. So over the years, we've also kind of, basically evolved our investing style and all that. So previously, it would be just that, this sector is not doing well, and valuations are good. So, I mean, I would buy, then wait patiently. That is something which we have loads of. So, but now over a period, what we are trying to develop is, we are trying to enter when, there is some sort of, evidence that, sector is turning, and so on. So, that is why, and that is exactly the strategy of the cyclical bets, small case, that we will invest whenever we feel a turnaround is visible or has just started. So the holding, the waiting period is reduced and so on. So that is obviously we are always improving the way we invest, and uh, uh, and of cycles, and I do understand, past cycles, and what are the things. So there's a lot of complementary things we have, uh, and uh, and that's what makes it work. And it's just that the kind of returns we've had. We want to basically say that it will be very very difficult for us to keep on churning these kind of returns. The return expectation should always be moderate. Anything about 20% consistently is very good. Uh, we've had far more than that, but then I was talking to this, Nitin, in the morning only, that we have to be extra careful and extra judicious, because uh, to sustain this kind of performance is not going to be easy. So we are aware of that, and in all humility, we say that we might basically see some bad periods also in the future. We don't know, but we'll try our best. Is what I can say.
Right, sir, and that's a very good strike rate, sir. So, Nitin, sir, I have seen your many of your videos, and you often focus about the accounting practices and identifying the red flags. So, what all? I mean, we often see companies adhering to financial shenanigans. So, any input or any view on that? How one should go about it in identifying the basic accounting practices, if not all?
So, over a period of time, what I learned is uh, uh, there are a few parameters which we should not be compromising. Okay, and if we are clear about that, we'll be able to avoid almost 80-90% of the companies wherein we may see some sort of difficulties, or we may be able to identify very early. You may not require a lot of understanding about the financials in to understand the difficulties in those companies. So what are those? That one is coming from the cash flow. Cash flow is the most important. What we look at, what investors look at generally is the P&L. Why they look at it? Because P&L comes every quarter, while cash flow generally comes in a year or maybe once in 6 months. So it's very important to focus on cash flow. Cash is the king. Cash is the real thing. P&L profit is not the real thing. Most of the people may not know that the profit shown in P&L is not the actual money received by the company. So if it is not the actual money, when the product is sold on credit, the actual money has not come. If actual money has not come, it may become bad debt in future, and if it becomes bad debt in future, it will trouble your P&L again, because you'll have to do a reverse entry. It's a difficult thing to understand, because everybody thinks that P&L is sacrosanct, and whatever is shown in profit is the real profit. Is not real profit. Money has not come. If money has not come, you are in problem, and that's where people make mistakes, and they end up buying the companies from FMCG or IT, wherein the cash flows are little more certain in many of the cases, and valuations may or may not be working, and they miss out on many other opportunities, where if this small point of cash flow would help them in looking at really good amazing opportunities with a lot of protections in of their investment. So cash flow is one. Second comes is the balance sheet, strength of the balance sheet. Look at if there is any equity dilution in the company over a period of time, if it is happening, how frequent it is, why it is happening. Very critical point. If there is a consistent equity dilution, and which we have seen in many of the companies from real estate or infra in the past, and all these companies got bust, avoid those companies. Third is from balance sheet is the debt level. If your debt levels are high, which are not manageable, if your debt level are more than the revenue you are earning, that is what we have seen in some of the ADAG group companies in the past, you will not be able to sustain. And if you are not able to sustain your investment, then equity will be the last one to be paid, because whenever there is a debt, the bankers or the lenders will have the first right on the assets of the company, and not the equity holder. They will come last in the queue. So avoid those companies if the debt levels are significantly high. Though it has another side, if company really does well operationally and is able to repay the debt, you will have multi-bagger in your hand, because all this debt will be repaid, and that will get converted into the market cap, what we were talking about little early. So keep a fine balance between the survivability aspect, very critical aspect, and look at the debt level. Third is, or rather, fourth is the quality of the promoter. And quality of the promoter can come in from multiple sides. One is, of course, the holding of the promoter. How consistent is he? Increasing, decreasing? What level? Why is he decreasing, increasing? And you knowing about that industry would also help. Ask a lot of questions in the con calls, or ask the questions from their competitors about this company whenever you are doing that research. That will give you lots of insights about that company. Ask in the market, do a lot of scuttlebutt about that company. You will come to know a lot of things which may not be available in public domain directly, and it is not an insider information because you are doing primary research about that company. So you'll understand that. And very very important is the quality of the promoter. So these are 4 5 very extremely important factors beyond P&L. So P&L is the last thing. Look at, I start with cash flow, then balance sheet, debt level, equity dilution, and promoter quality.
Yeah, Jiten sir, anything more you have to?
Yeah. So yeah, I mean, there is no substitute for promoter quality. So see, over the years, I have also made in my career, I made mistakes where I have invested in not so good promoters and all that. But over the period, kind of learned these things and understood that promoter quality is so important. And how do you judge promoter quality? I mean, there are so many. You need to put in some hard work. You need to read annual reports. You need to see what they've said in the annual reports and what they are doing subsequently. You need to, most of the companies in our investable universe would actually be doing con calls. Not all, but most of them. So you listen to or read the con calls for a long period in time, and that will tell you about what the management says and what it does and so on. So basically what you can do is you can make a kind of a picture about the management if you do all these things, and then you also look at past cycles, what they have done, what are the margins, what are the look at what are the good cycle margins, what are the bad cycle margins, how are they in comparison with the competitors and so on. So that will tell you a lot about the promoter quality, and that's how we build the picture about the promoter quality. Apart from all this balance sheet things we look at, because we always like promoters who you kind of who under promise and over deliver. Those are the kind of promoters who actually make a lot of money for you. I'll give an example. Few years back, there was a company which was into printers and so on. The promoter was all over TV all the time, giving huge, big projections and so on. I kind of always don't like those kind of promoters, to be honest. And I did some digging because some of my friends had, you know, uh, huge quantity in this company. They requested me to look at it, and I did some scuttlebutt. I did some, I talked to a lot of people in the industry. I talked to, some of their customers and so on. And then I kind of realized that, there is something seriously wrong with this company. And this company, it was, I mean, Japanese company. We all know what happened to that. But I
MNC,
think,
no, not Japanese, MNC pedigree, because that was one
yeah,
of the
yeah, MNC.
clients that we have.
MNC, Japanese MNC. Yeah, yeah. So these are subtle things which you kind of look at, and over the years you kind of also try to understand the body language of promoters and so on. Uh, we would rather talk to the management on con call than meet, because there will be some promoters who are so impressive that they will impress you so much, and so you know at most of the times we actually avoid meeting promoters, contrary to what a lot of people say, that
Or
you
we
must
may
meet the
actually
promoters.
we may meet actually after significant amount of time has already gone while we invested.
Exactly. Mm,
So, for example, I invested in a company a year and a half ago, and this year I
mm,
met just
mm,
a month back. So 18 months have already gone in that investment. After that, I'm meeting him, and when I saw that what he was saying he is executing, and then we
mm.
decided to meet. Otherwise, going on the con call is a better idea, as Jitin was saying.
Yeah, yeah. So, some of the softer aspects also I wanted to point out.
Just one more example that I would like to give in addition to what you talked about of that Japanese company. So मार्केट एक ऐसा प्लेस है ना, बड़ा मजेदार है यार ये. यहाँ पे क्या है ना, बाहर हम बोलते हैं ना, किसी को एक बार मूर्ख बन जाए तो बार बार नहीं बनता है. मार्केट ऐसा है, यहाँ पे वो मल्टीपल टाइम भी मूर्ख बनाते हैं. आई गिव यू एन एग्जांपल ऑफ ए चड्डी बनियान वाला कंपनी. अभी वो एक चड्डी बनियान वाला जो कंपनी है ना, वो 2013 में 14 में उसने बड़ा स्टोरी मारा. ओके, आई अचीव 1000 करोड़, आई एम बिकमिंग नेक्स्ट दिस कंपनी और दैट कंपनी. और वो कंपनी 25-26 रुपए से सीधे 75 रुपीज हुआ. ओके, और उसके बाद कुछ एग्जीक्यूट तो हुआ नहीं, तो वो गिर गया 2015 के बाद. एंड इट केम डाउन अगेन बैक टू 25-26 लेवल. And then after 5 years, he came back with the same story. What he said in 2012, 1000 crore, and same story was there in all media coverages. I looked at the articles which were published in 2012, exactly the same. And then again, stock was four bagger. It reached this time it went beyond 75. It reached 100, and again it is back to 23 in 2022. So यहाँ पे है ना, वो मल्टीपल टाइम मूर्ख बनाना का काम है. और कंपनी ने नाम भी चेंज कर लिया अभी तो. वो चड्डी बनियान वाला कंपनी का नाम भी चेंज हो गया अभी.
Yeah, yeah, there was one darling also sometime back, I think, and some marquee investors were also invested into it, and it was very, very clear that probably was, I think, the fourth or fifth name of this company, and promoter quietly offloaded everything, and investors are screwed. So not everything is very bright.
Right, sir. So some of our audiences who are facing issue with the voice, I request them to kindly refresh or try with from their laptops. Some of who were experiencing and trying from laptop have got the voice right. And moreover, this session is recorded, so our apologies if you are not able to hear it live. You can revisit and we'll be sharing the recording also. Yeah, so next question is from Kumar Saurav sir. He is asking, please provide a framework for valuing industrials and how do you interpret current valuation with industrials with respect to tailwinds and longevity of the cycle?
So, I mean, the thing is, we think that uh, these companies will do well for quite a while. I think the best way to look at valuations is I think you would look at is EV EBITDA. That is something which you can look at. I mean, how much you want to give value to that. At what value, what EV EBITDA you will be comfortable at. That is something personal to decide. We also have to see that EBITDA is going to be a moving figure. So you need to understand also, how these companies are going to do in the future, and so basic industry knowledge is very, very important. But from a valuation perspective, I think EV EBITDA is probably one of the better parameters to look at.
Right, sir. So, Nitin sir.
Hey, sorry, I have to leave now, Prince. So you guys carry on. Uh, Sorry about that, and thank you for your time. There's some work that is there, and it was already scheduled. So
Right, sir. Right.
I'll let you know
Sorry,
now.
on my part, I didn't ask on the time, so there were many questions. Sir, it was really nice having you both, and it was really insightful. And perhaps we will love to host you some other time as well. So it was really insightful, and people can visit today's session over recordings. So thank you.
I can,
Yeah, yeah,
Prince,
sir.
I can
Yeah,
stay for 10 more minutes.
yeah, yeah,
There.
sir.
Yeah,
So I'll be.
yeah,
Yeah, yeah. Thank you, Nitin,
sure.
sir.
Thank you, Prince. Thank you, Jitin. Thank you, everyone.
Jiten sir, one question is again on the paper sector. So, one Mukul has asked the valuation of paper sector after the recent move up. So, if demand is so high, then why none of the big players are announcing capex to capture the demand?
Yeah, I think so. One thing you have to understand that raw material in India is not ample. You can't expand too much. Uh, if you expand, then you will have to depend on importing your raw material and so on. So and another good thing is the maybe the companies realized all this that expanding at this point in time might not be a good idea. That's basically wait for some time. The thing is, I don't think the companies themselves knew that such good times will come so fast. To be honest, but the go- uh, turnaround was definitely something which we were expecting. Uh, but what has happened is, this Russia-Ukraine war actually also acted as a big tailwind. So we have to understand that that is something which has benefited the sector because pulp prices are strong because of that, uh, uh, and you don't know. I mean, we need to keep on tracking whether companies announce uh, expansion or not, because quite a few have actually gone through expansion recently only. So they might want to basically wait, deleverage, and so on. Uh, so not expanding is actually a good thing for the paper cycle.
Right, sir. So we have another interesting question. That person is asking, Murugappa Group acquired power company. It's an opportunity. But when Blackstone acquired some real estate company, so till now that has not been fruitful. So the narrative is same: when good management takes over, things would change. But other things to watch out in both the cases if the companies are not doing well.
So again, there are host of factors. Real estate is quite cyclical in that sense. Uh, and a lot of times, some of these sectors or this PE firms buy these companies and then they kind of realize that there are a lot of skeletons and all that, and that is happening with many companies. So it does take time. We are very skeptical actually. There are many examples where PE firms have taken and then the company has not gone anywhere. In fact, they have come out. A lot of cleanup is happening and all that, and that puts a lot of pressure, obviously, on the stock price. So you should be mindful of that also. That these things can happen. So again, there is no holy grail or there is no single answer for this. Uh, some companies, it could be that the cycle, somebody acquires and the cycle turns and it might do well. And for some companies, it could be that they acquire and cycle goes down, so they might not do well. So something like that also can happen. It's very difficult to pinpoint because there are too many moving parts.
Right, sir. So, sir, for a layman, like how one should decide whether an individual is fit for investing in cyclicals or he or she is not fit? I mean, how to gauge that thing?
So again, it is lot of it is behavior. I think we can't stress the importance of behavior. It's a very patient game and it's a very lonely game. Uh, at least the way we invest. So when we are investing, nobody is looking at that sector. There are no reports. Nobody is interested in it, and that is when you get value, right? When nobody is looking at it. So if you have that mindset, then you can go for these cyclicals. But understanding of cyclical, I think everybody needs to have, is what I think. At least market cycles, people should understand. Uh, if not the business cycles, market cycles, people should understand. The same FMCG companies you know, will have a long period where, despite growth, they will not give any stock returns, and with similar growth, will give completely different returns in same period. I always give example of a large FMCG company, which from 2001 to 2011 gave zero return, despite the top line doubling in that period, and of course bottom line also going up, not to that extent, but still going up significantly. And in the next 10 years, again top line doubled, and bottom line was slightly better than the previous this thing, but still no reason for this stock to be 10x in this 10-year period, against a zero return in this. So market cycles are at play. Starting valuations matter a lot. Uh, so I'm not a proponent of buy at any price. It's a simple thing people can do is look at on a tool like Screener or something. What is the 10-year growth rates? What is the 10-year growth rate in sales and all that? 10-year, 5-year, 3-year. You can just gauge that, and then what is the stock CAGR over that period? If you are seeing that the sales and the profit growth is, let's say, 10-12%, and the stock CAGR is 30%, then there could be a good chance, your margin of safety is very, very poor, that this stock might underperform a lot, So simple things like this can be done for the seemingly non-cyclical companies also.
Sir, one take, like I have myself experience, and even a majority of people feel like when it comes to advisory or some sort of consulting an expert, people are hesitant. They want to try things on their own, even when they are not capable of. So we also know that there are people who are on the ethical side of selling things or maybe advisory, and there are many people who are into mis-selling also, and it is very difficult to segregate between the two in initial phase. But again, seeing the importance of advisory, you have any view for our audiences, like if they are starting their journey, how they should go about it if they themselves are not capable of investing it the right way? Sir, we cannot hear you.
Sorry. I was on mute. Very sorry. So, what I want to say is that if you want to invest directly, then you must learn the basics. You must understand valuations and so on. So basically, there should be some understanding which is required. Uh, Buying on basically what they call as tips is something I think is a road to disaster. Sometime or the other, you will go wrong, because what happens is, how will you build conviction? Conviction can come only when you do your own study, and you understand things, you understand the company, you understand the sector, and so on. Cyclical, non-cyclical, doesn't matter. For even a growth company, let's say you want to invest in a FMCG company, you need to understand the company, right? You need to understand the valuations and so on. You need to understand who are the competitors and so on. So those things are required if you want to do it directly. If not, then it is always better to take help. Is what I would say. Not because we are. We have a firm doing that. Just that it is always you don't self medicate if you fall sick and so on. So there will always be good people. There will always be bad people in the industry. And there will always be good doctors. There will be bad doctors and so on. So every industry will have different kind of people. Uh, uh, so basically, you need to search for a good person, or if your expectations are moderate, then best way is to go the mutual fund way. Uh, but then mutual fund, obviously, we all know that they have their own set of limitations and so on, in the sense that they will be far more diversified than what and then they will give that kind of return, obviously, only. But if market corrects, hopefully they will fall lesser, and so volatility will be low in mutual funds. And so you need to decide if you want to learn. You can basically do it yourself, start small, keep on learning, make some mistakes and so on. But I would say, first preference should be given to, that you can do it yourself. uh, and that is the reason, me and Nitin, we always shared our experiences, despite having all this, because we always believe that, uh, best way to do it is, do it yourself. But one should not be, but one should do it in the right way. That is also important. One should not have any ego, uh, that, no, I will do it myself without understanding.
Right, sir. So, sir, one question, like you and Nitin sir are working together since 2015. So, if you have some idea and Nitin sir has some other views on that, so how you come to a conclusion whether the space is investable or not? I mean, how the process is?
No, so again, so in that sense, see, we understand each other very well. That can happen once in a while, and then we will let it go. Even if one of us says that, this is something which we need to avoid, we will let it go. There is no ego in this at all. Both should be comfortable. That is key criteria. So once in a while, something like that does pop up, where maybe Nitin likes it, but then the idea is, if I don't like it, then I have to convince him. And we are both reasonable in that sense, And if I like something and Nitin doesn't like, then he will convince me, and we will get convinced, since we understand. The thing is that, I know that Nitin will not say no just because of that. He would have his reasons, and uh, that trust and mutual understanding we have.
Right, sir. So we have another 5 minutes with sir. If any questions from the attendees, they can send in the request. I'll approve. And in the meantime, Jiten sir, you are a proponent of bottom down. The stock specific approach. So have
Right.
you ever? You also look for a basket approach sometime, or it's like stock specific only?
No, so I mean, the thing is, basket approach is always better uh, on an individual level. But let's say when you are running a service, you can't have 40 stocks in the service. We have kind of limited to 20 stocks. So we might have two or three at the most. Like for example, in paper we have two, uh, cement we have two, capital goods we have three. So yes, we do apply the basket approach there also. In personal, I might have, let's say in capital goods I might have five investments, because you know I can also look at the smaller companies which or the riskier companies for myself, but that might not be a right investment for clients, or that it might not be liquid enough for our clients to buy and so on, or the market cap, it could be below the market cap, which is needed for us to recommend something and so on. So those things can happen, uh, but I think basket approach is a good approach. Investors should definitely look at that. So for example, let's say in financials, we don't mind having three of such a vast field. So banking and financial, there could be case of three or four bets in your portfolio and so on.
Right, sir. I think I have many requests, but I'm not saying due to Twitter glitches. Never mind, we can have another round with team Aurum sometime. We will request them again. So Jiten sir, one last thing. I had one comment from attendee. He was asking like you had offered some discount recently on completion of 4 years. So share that guy is asking is it still continuing or that has been stopped? So any input on that?
So, so basically, on our website, it is continuing. Uh, on small case, it has stopped because that was till the 10th. It was a very big discount on small case. Actually, we had given 50% off. So it was definitely for a limited period. So that is small case platform has offer code and all that. So that offer code has expired. So you'll not be able to use it. So, but we might have some smaller discounts of course. If anybody is interested, they can write to us. Yeah. But that one, the 50% off on small cases over.
Yeah, thank you, sir. So again, those who have interest and want to contact, they can directly contact, so they can get to know about the discount and other things on the website itself. So Jiten sir, thank you so much, and thank you. Please pass on my good wishes to Nitin sir as well. It was really insightful from your end, and thank you for sparing 90 plus minutes for us, and it was really helpful. So we couldn't take too much request due to Twitter glitches, but again we can always have a second round of conversation. It is always pleasure listening to your audios and Nitin sir's theory. So thank you so much for your time, sir. Any closing
Yeah.
remarks for any closing remarks or any sir means any what we say for our beginners in the investing journey? So any inputs for those that.
So two things, uh, patience, very very important, and do not have loss aversion. This is one aspect which is not discussed much. You know, uh, uh, a lot of people have loss aversion. So if you are wrong, then you need to book a loss if required. Uh, that is a fundamental mistake many people do. A lot of beginners do. And second is obviously they lot of times don't have patience. So these two things I think are very important. So thank you, Prince, for hosting this, and we are sorry for the Twitter glitches. If anybody's had maybe in the recording, I think everything will be clear because I could hear everything what Titin said and what I said, except maybe for 5 or 10 seconds of total 90 minutes. So I hope the recording will be good. And thank you so much for on a Saturday evening spending 90 minutes listening to us, and uh, uh, have a good weekend, and happy Independence Day to all of you.
Yeah, same to you, sir, and thank you so much. And we see many popular faces listening to our spaces patiently. Vilumani sir, Deepak sir, and many more. So thank you for everyone who have listened to our spaces very patiently. And guys, if you are liking our spaces, kindly connect with our handle so that in future also we can you can be a part of conversation, which basically the social responsibility which Jiten sir and Nitin sir always talk about is a two-side thing. We learn from each other, and it is always good to give back to society. So 4 5 decades of experience of team Aurum has been shared today. So kindly revisit to recording on our handles. We will it will be available for next 30 days, and if other recording space or wealth podcast has recorded, they will also place it on YouTube for the benefit of masses. So thank you so much, and we'll see you all again. Thank you so much for listening patiently, and happy Independence Day in advance to everyone.
Bye bye, everyone. Thank you.
Thank you.